This video is a deep dive in Tesla's Q2 2025 results. At time of this recording, it's about 12 hours after publication, so it's pre-market the following day. Tesla sold off about 6% now, even though the stock held right after publication of the numbers. This implies that management said something on the call the market wasn't too happy about. In this financial deep dive, I will discuss these points as we look at the relevant numbers. In this presentation, I will be discussing Tesla's key P&L drivers, operational drivers, cash flow drivers, and cash development. So let's dive right in. This first chart shows you revenue development. Total revenue was down 16% sequentially. Sequentially means quarter on quarter. I'm sorry, I misspoke. It was up 16% quarter on quarter, but was down 12% year on year to 22.5 billion. This chart shows you the key drivers year on year. So in 2Q 2024, the company generated 25.5 billion, and this total revenue number came down to 22.5 billion. And the main revenue reduction driver was the auto business, excluding credit sales. Regulatory credit sales also came down. The energy segment also came down, and the only segment of the four main segment categories that improved year on year was the services and other segment. That segment contains Tesla's global fleet management operation, insurance, charging operations. So the year-on-year decrease was 12%, as I said before. The auto segment without credit sales decreased 15%. Credit sales are down 51%. The energy and storage, energy generation and storage segment is down 7%, and service and others up 17%. And in terms of overall contribution to the year-on-year decrease, the auto segment contributed 92% to the decrease. 15% came from regulatory credits, 7% came from the energy segment, and there was a 15% offset of the decrease coming from the service and other segment. Now let's look at total revenue development quarter on quarter. As we said earlier, quarter on quarter total revenue is up 16% from Q1. Q1 was at 19.3 billion. The primary driver was the auto segment that was up 2.9 billion or 21%. The service and other segment was also up quarter on quarter by 15%, adding 408 million in revenue. Regulatory credits were down 156 million. That's a decrease of 26% quarter on quarter. And overall, in terms of contribution to the quarter on quarter total revenue increase, automotive contributed 90%. 13% came from service and other. There was an offset of 5% from regulatory credits, and there was a small contribution from energy storage. Now let's run quickly through each main segment. First, auto segment revenue decreased year on year 15%, as we said, but is up 21% quarter on quarter to 16.2 billion. Vehicle sales were a main driver, but there's another driver we get to in a second. Vehicle sales were up quarter on quarter 14%, but it's normal in the second quarter because the first quarter is always very bad because of winter in many global markets and Chinese Lunar New Year. And you can see this when you look at 2024. The second quarter was also up 15% sequentially. However, sales are still down 13% year on year. However, something that's very positive is that the average selling price increased in the second quarter, 7% quarter on quarter, but is still 2% down compared to the second quarter of last year. Average selling prices came in at 41,100. Now let's look at regulatory credits. So Tesla earns these credits on selling zero emissions vehicles, and Tesla earns them in markets globally. However, one of the most important markets, the United States, now effectively eliminated credit trading, and that will have a material effect on Tesla's regulatory credit sales recognition. And I think what you can see in this chart, that an impact is already reflected. Tesla's regulatory credit recognition dropped to a 6-quarter low. So in the second quarter of this year, these credit sales came down 51% year on year and reduced 26% quarter on quarter to 439 million. What makes regulatory credits so important is the fact that they have no cost against them. And that's why they have a disproportional gross profit impact, as we will see later in this presentation. Now let's look at energy generation and storage revenue. Came down 7% year on year, but increased 2% quarter on quarter to $2.8 billion. The main driver of the year-on-year decrease was, as you can see in this chart, not deployments. Deployments actually increased by 2% year on year, however, came down 8% quarter on quarter to 9.6 gigawatt hours. The main driver was what you see on this chart. The revenue per kilowatt deployed reduced significantly year on year by 9%. However, what's encouraging is it's up 11% quarter on quarter. The quarter on quarter increase is actually, or what I believe, driven by tariffs. And Tesla alluded to it on the call by saying that customers accept higher costs from tariffs. Now we move on to the services and other segment, and you can see it achieved for the first time ever in a single quarter more than 3 billion in revenue. So it's 3 billion and 46 million. That's a 17% year-on-year growth rate and is up 15% sequentially. This segment is Tesla's most consistently growing segment, and you can see up here in this long-term trend that there's only one negative change, and this was the first quarter of this year, where for the first time there was a sequential decrease in revenues, but otherwise this segment has always been growing quarter on quarter, which makes sense because it's significantly driven by Tesla's global fleet size, which is continuously increasing. Unfortunately, as we will see later, this is a low margin business and therefore not a major earnings driver. Next, we look at cost, and we start with average vehicle production cost. And you can see in this chart, production cost is up 4% quarter on quarter, but it's down 2% year on year. Since Tesla ramped fairly quickly the new Model Y, I believe most of that production cost increase is actually tariffs related. Next we look at average production cost in energy storage. So this chart shows cost per kilowatt deployed. So not price, but cost to Tesla. And we can see that year on year, cost came down 16%, but increased 8% sequentially. And Tesla talked about this on the call. From the big beautiful bill and tariffs, the most affected segment is actually the energy segment and not even auto. So as a result, we might see further cost increases going forward. But ultimately the question is whether Tesla can pass the cost increase through to customers or not. Now we get to gross profit. So gross profit was down 15% year on year, but is up 23% quarter on quarter to 3.9 billion. Let's first look at the key drivers of the year on year decrease. So in the second quarter of 2024, Tesla generated 4.6 billion in gross profit. This came down to 3.9 billion, and the majority of the change was driven by a reduction in regulatory credits. As you can see in this chart, this caused a loss of 451 million in gross profit, and even exceeded the loss in gross profit in the auto business, which reduced by 348 million. The only bright spot in the year-on-year comparison is the energy segment, which added 106 million in gross profit. So in terms of gross profit year on year, the main driver of the decrease was clearly regulatory credits and then followed by auto. Now let's look at the quarter on quarter gross profit change. So in the first quarter, Tesla generated just over 3.1 billion and finished the second quarter with just under 3.9 billion. 756 million of the increase came all from auto. There was a small offset from a reduction in regulatory credits of 156 million. And then there were two positive contributions from energy, which was up 61 million quarter on quarter, and the service and other segment was up 65 million quarter on quarter. So now let's look what all this means in terms of margins. So total gross margin across the entire business is down 0.7 percent points year on year to 17.2. So last year in the second quarter, Tesla was at 18.0%, now 7.2. However, sequentially, the margin is up 0.9%, so from 60.3 in the first quarter to now 17.2. So now let's look what contributed to the margin improvement. So this chart shows the auto gross margin excluding leasing and also excluding regulatory credits. Here Tesla registered a significant sequential improvement of 2.7 percentage points from 11.3% reported in the first quarter to 14.1% now in the second quarter. This is even slightly up compared to last year, so the year-on-year shows a 0.2 percent point increase. In the second quarter of 2024, the margin was 13.9%, and the second quarter of this year, 14.1%. So this is very positive. This is likely driven by the global rollout of the Model Y, the new Model Y, which attracts a higher selling point, or I should say, fewer incentives. Unfortunately, due to what Tesla said on the call, it's likely that this trend reverses, in part due to FSD not being available globally due to still existing regulatory hurdles. Then next, this chart shows you auto gross margin, including the leasing business, but excluding the regulatory credits. And this margin rose from 12.5% in the first quarter to now 15% in the second quarter, and is also up year-on-year from 14.6%. Then the fully loaded auto gross margin, so including leasing, including regulatory credits, is up 1% quarter-on-quarter to 17.2%, but down 1.3% year-on-year. Then we move on to the energy segment, which delivered almost a new all-time high with a gross margin of 30.3%. This means, based on what Tesla said on the call, the second quarter of this year would have been an all-time high without tariffs. There was only one quarter where the margin was even slightly higher. That was the third quarter of last year at 30.5%. And this also contributed, I think, to the sell-off in the stock, because Tesla was warning by saying, and I quote, "The challenges of the storage business definitely come both from the BBB and from tariffs. We will see shifts in demand and profitability." Shifts in demand and profitability. This is typical CFO code for weakening demand and lower margins. The fact that Tesla did not repeat their aggressive 2025 energy deployments guidance likely worried many investors. I still think they will deliver, of course, all-time high deployments this year, etc. But instead of perhaps slightly beating their prior guidance, what many perhaps expected, might just meet it. The service and other segment margin improved 1.6% points sequentially, but is down 1.0 percent points year-on-year, and came in at 5.4% gross margin in the second quarter. Now we move on to operating expenses. So operating expenses comprise research and development, SG&A, and in case there are any restructuring and other charges. This quarter, second quarter, didn't see any restructuring charges. Tesla's operating expenses reached a new all-time high in the second quarter. If you account for the all-time highest restructuring charges recorded last year in the second quarter. And this is also why you see this temporary peak and then the trough. So what was driving this? This was driving it. R&D expenses going through the roof. I talked about this last quarter. What's pushing R&D expenses so much higher is, number one, the talent war in AI. Given all the crazy high compensation packages that you see in this industry-wide, Tesla will also have to increase compensation for their AI engineers in order to avoid poaching from other companies. Plus, Tesla's massive spend on AI infrastructure also means there is an added burden from depreciation charges on these data centers. But compensation will be by far the biggest driver of this item. And this was another aspect that probably worried investors in yesterday's call. Tesla said, and I quote, "Our operating expenses, especially R&D related spend, will continue to grow." So the issue is, it's already, as you just saw, at all-time high levels, and Tesla is telling investors, "Oh, guys, it's going to go up further." So keep that in mind, because we will come back to this point in a little bit. But before we move on from R&D expenses, just look at the increase. So year-on-year, R&D expenses increased 48% to just under 1.6 billion, and are up 13% sequentially from the prior all-time high. So R&D expenses are literally going through the roof. And Tesla is telling investors it's going up even further. But operating expense pressure does not even only come from R&D expenses, but also from SG&A expenses. And you can see in the second quarter, those were up 7% year on year and 9% quarter on quarter, and now but nearly touched the prior all-time high in Q1 2024, immediately after which we saw Tesla's all-time highest restructuring, which saw significant layoffs. So now let's put this into perspective. So this chart shows you operating expenses relative to revenue. You can see in the first quarter, it spiked up to a long-term high of 14.2%. So 14.2% means in the first quarter, Tesla spent of each dollar in revenue, 14.2 cents just on operating expenses. So that's quite high. But because revenue increased in the second quarter, this, let's call it efficiency ratio, improved, and it came down from 14.2 in the first quarter to now 13.1% in the second quarter. So this next chart breaks that ratio down into R&D spend, and then the subsequent slide we look at will show the SG&A component, and you can see that the majority of Tesla's OPEX, operating expenses, goes into R&D, and is at the very high 7.1% in the second quarter, which is a little lower than in the first quarter, which was 7.3%. But still, if you compare to the prior quarters, it's a substantial increase. And don't shoot the messenger, but basically this means Tesla is increasingly focused on AI products. If Tesla felt super comfortable in its position, it would likely not blow R&D spend up to this level. That's just my honest view, just analytically. There's no way you can spin this logically to explain this in any other way. And this is exactly what we see in these other hyperscalers. They spend as much as they can on R&D, AI infrastructure, because the Google, Meta, all these people, they feel threatened. And this is driving ludicrous increases in R&D spend in Capex. And in the numbers, we see exactly the same pattern in Tesla. I know this will hurt the Tesla fan hard. It does hurt me, but it's just analytically what I have to conclude when I see these kinds of numbers that are far beyond the historical norm. Next, we move on to SG&A. You can see that SG&A margin is also quite high. So the percent of each dollar of revenue Tesla spends on SG&A, so selling, general, and administrative expenses. This can have many drivers: increased shipping costs, increased advertising spend, increased sales costs. Since right now the 10Q isn't out, I can't tell you what was driving this increase, but I suspect it also relates to tariffs and just increased sales efforts. I've seen the same pattern in many other automakers. In simple words, it just has become much harder to sell vehicles right now. So on this slide, you now see the net result from the year-on-year weakening gross profit, the higher operating expenses. This shows you operating profit decreased 42% year-on-year to 923 million. On a positive note, it was up sequentially 131%, but obviously this very high growth rate was driven by a very low base in Q1, where operating profit was affected by various headwinds. As a result, the operating margin came in at 4.1% for the second quarter, which is the lowest reported margin in many years, except for the first quarter of this year, implying a year-on-year decrease of 2.2 percent points from 6.3% in the second quarter of last year. So maybe let's pause for a second on this slide, because it's a very important one, because it kind of tells you the full story after everything you already listened to in terms of why the stock sold off. Tesla was telling investors the costs will increase, operating expenses will increase. One thing we basically know for sure is that this will not help the earnings outlook. On top of all of that, Elon at the end of the call told everyone that the next 3 quarters will most likely be tough quarters. And this then obviously meant that some investors thought, I rather trim or exit for the time being to not be exposed to significant downside risk. The other element that wasn't very helpful, and that probably also added to some people perhaps taking a pause in terms of their Tesla exposure for now, was that Elon commented that the timeline for Optimus production slipped. Previously, Elon guided for several thousand units at the end of this year. In the call yesterday, he talked about that the upcoming Optimus V3 version is the first version that can really work, basically. I'm simplifying what he said. And that version would only start production in the first quarter of next year. And then previously, before the call on X, Elon said that there would be at the end of the year a V3 presentation, which then obviously creates a couple of months where investors might sit on very little positive news flow, but face ongoing negative news. This came on top of Elon announcing that the new lower cost vehicle would look like a Model Y. So the rumor from last year that Elon would go for a, quote, stripped down version of the Model Y effectively turned out to be true. And this is also why they didn't launch the lower cost vehicle in the second quarter, because it didn't make any sense. And the reason why it didn't make any sense was that because of the end of the tax credit in the United States, there's currently increased demand for Model Y, and the current lineup sells at higher margin than the lower cost one will. Plus, obviously, the transition to the lower cost Model Y that has never been manufactured before would cause some complications in terms of manufacturing, supply chain, etc. And therefore, there was no point in launching it in the US. And the plan was always to first launch it in the US and then later roll it out in other geographies. This added to the worries investors had. And this point that if the lower cost vehicle was only a stripped down Model Y would be inadequate to increase meaningfully the total addressable market. I'm not saying this is necessarily what's going to happen, but this is what I was told in countless investor conversation, from small retail investors to quite large investors with over $100 million portfolios. But let's move on. The rest of the P&L is not that exciting. Non-operating items comprise interest income, interest expense, and other income or expense. And you can see there was a 626 million income in the second quarter. And this was primarily driven by a non-cash item, and there was the appreciation of Tesla's Bitcoin holding. The net result was that profit before tax reduced 18% year on year, but was up 163% quarter on quarter. But again, this was on a very low first quarter base. Despite the larger profit decrease, Tesla's tax provision was only down 9%. So one cannot argue Tesla benefited from lower taxes or something in this quarter on a relative basis. Because sometimes people make the argument, if there's a quarter with very low tax provision, it means the earnings are of lower quality. This is not the case in this quarter. Then we arrive at net income. Net income reduced 20% year on year, but is up again 183% quarter on quarter on this super low first quarter base. This chart just shows you non-controlling interest. This is in most quarters not a needle mover, so we move on, do not waste time on it. Now we arrived at shareholders' net income, which decreased 21% year on year to just under 1.2 billion. And after the first 6 months, 2025 is down 39% compared to last year and brought in just under 1.6 billion net income. Here, just a quick look at net income adjustments to get to adjusted shareholders' net income. This quarter, there was a relatively low add back of just 221 million, mostly comprising share-based compensation. And now we finally arrived at the bottom end of the income statement. This is adjusted shareholders' net income. Well, technically, it's not part of the income statement because adjusted shareholders' net income is a non-GAAP item, but it's the most useful for valuation purposes. And Tesla delivered just under 1.4 billion in adjusted shareholders' net income in the second quarter, which is 23% down from last year, but is up 49% sequentially. After the first 6 months in 2025, adjusted shareholders' net income is down 31% to 2.3 billion. There's just a quick look at share price development. You can see Tesla slowly dilutes, but not very much. You can see, for example, in first quarter, share count grew by 1.1% year on year, is even slightly down quarter on quarter. So nothing major to see here. For example, a company like Palantir has significant dilution because Palantir pays away a relatively high percent of revenue in employee compensation. So now we arrived at adjusted EPS. So this is the most interesting metric for valuation purposes. And Tesla's EPS came in at 40 cents per share, which is right in line with where consensus was. I saw some reporting saying Tesla missed by 1%, which really depends what consensus you're looking at. Ideally, you look at FactSet consensus or Bloomberg. but a 1% miss is really nothing. So this certainly did not explain the sell-off in the stock, but it's much more likely that the points I mentioned earlier represent the key drivers. So EPS came down 24% year on year, but is up 49% quarter on quarter. Now we move on to cash flow. This chart shows you operating cash flow. Just super quick, what operating cash flow is. You start with net income, and then you add back all the non-cash items reflected in net income. So for example, depreciation and amortization is lowering your net income, but there's no cash outflow against it. So in this cash flow calculation, you add back depreciation charges to net income. Same for these other items that you see here. But then you also have to make deductions from net income for things that actually caused a cash outflow, but for which you did not account for in your net income. For example, inventory, when it goes up, Tesla makes a car, doesn't sell it. The cost of making that unsold car is not reflected in net income. But of course, you bought parts, raw materials, etc. From suppliers, and you had to pay labor, people putting it together. You had a cash outflow. So that means when inventory goes up in the balance sheet, it is cash flow negative. So that's why you have here a deduction. And then when you add all these pluses and minuses up, you get to operating cash flow. This is a much better way of looking at a business performance than just by looking at profitability metrics that are derived from the income statement. So Tesla's operating cash flow was down 30% year on year, but is up 18% quarter on quarter. So this chart shows you what was driving the quarter on quarter increase to see whether this was a quality improvement or not. A low quality improvement would be if Tesla just increased the amounts payables. In other words, Tesla decided to pay fewer suppliers or pay them later. But based on current disclosure, and again, as of right now, I don't have a 10Q, it's not out yet, but based on the cash flow statement disclosed in the shareholder deck, Tesla's second quarter cash flow looks fine. The increase came primarily from increase in net income after you deduct Bitcoin. So, and just to, in case it's not clear how this works, you see here Bitcoin had a negative change of 409 million quarter on quarter, even though there was a positive income statement impact in the second quarter. You might be thinking right now, this can't be right. But you have to keep in mind that the Bitcoin income statement impact is a non-cash item. So any positive you report in the income statement, you have to back out in a cash flow perspective. And because in the first quarter, there was the opposite case. Bitcoin was down. Tesla recorded a loss. And so if we did this analysis that you look at right now, in the first quarter, the Bitcoin cash flow view would have been positive because you would cancel out the first quarter P&L loss. So the bottom line is the operating cash flow improved absolutely not because of Bitcoin. It can't, but because of underlying improvements in business, because net income was the primary driver and changes in operating assets and liabilities largely canceled each other out and had a slight negative impact on cash flow. If Tesla tried to boost artificially its cash flow and not pay suppliers, then what we would see here is a significant positive number here in this category, changes in operating assets and liabilities. But we don't. We see the opposite. We see a negative number, and hence this is not the case. Hence we know the operating cash flow is clean. Then we move on to capital expenditures. So capital expenditures are anything Tesla expanding factories, buying robots, machines, tooling, etc. All these long-term goods. And then, of course, AI data centers is always reflected in Capex. And in the second quarter of 2025, Tesla spent almost 2.4 billion in Capex, which is up 5% year on year and is up 60% quarter on quarter. But after the first 6 months of 2025, Capex is down 23% and sits at just 3.9 billion. Based on what Tesla said yesterday on the call, we likely see that Q3 and Q4 will have higher Capex spend because Tesla was repeating the 9 billion Capex guidance for full year. And then when we look at the net result of operating cash flow, less capital expenditures, we get to free cash flow. Free cash flow is one of the most important metrics in any company, except financial institutions. And you can see that in the second quarter, cash flow decreased to just 146 million. And this is really a result of ongoing high Capex spend, weakening gross profit, higher operating expenses, but bigger picture long term is not a massive problem. But why I will tell you in a second. But before I do, I want to show you something else. That's Tesla's financing cash flow, and you can see that Tesla did not take on any net debt. Tesla obviously didn't raise any equity, and financing cash flow, so the sum of all debt issuance and debt repayments was net negative 222 million. So the debt amount went actually down. Tesla overall has very little debt, but the little debt it has reduced even further. And then the net result of the positive free cash flow and slight negative financing cash flow. You see here, this is the cash balance from Tesla, and this cash balance includes all the cash items, so not only the cash balance itself, but also restricted cash and short-term investments. That's the correct way of looking at cash. So because Tesla paid down a little bit of debt and cash flow was very small, total cash balance decreased slightly by 1% sequentially, leaving Tesla with just under 37 billion in the bank. And this makes Tesla extremely well capitalized, given it has almost no debt and has a fairly limited operational leverage compared to automakers with a similar cash position. But that's a topic for another video. So before we close this video, let's just have a quick look again at the share price reaction. So stock down 6%. In summary, I think this was driven not by the tiny earnings miss, but it was driven by Tesla's negative next 3-quarter outlook, driven by likely cost pressure from tariffs and other effects, massive spending on R&D, which is ballooning operating expenses, likely some disappointment amongst certain investors about the lower cost vehicle, which is just a trim of the Model Y most likely. That investor disappointment was likely increased by pushing Optimus production version into the first quarter of next year from the fourth quarter of this year. And overall, I think the tone during this call was significantly, or I should say meaningfully, less optimistic overall. Some people might say that the vibe was just different this time. And I think all the things that I just listed, they compounded and drove the reaction during and after the call. Because again, keep in mind, the moment the numbers dropped and prior to the call starting, the stock held the $330 level. With all this information that we got from the 2Q disclosure, from everything management said directly or indirectly on the call, I will update my detailed Tesla forecasting model and share price projection, and will post it to my subscribers on X. In case you're interested what my Tesla forecasting model looks like, here I show you a little bit of it. This is just the revenue projection. Sorry, this is not the revenue projection, it's just the sum. That is the revenue projection. You know, it's like several hundred lines. So you can imagine a lot of work goes into this. Here are some cost projections. Other separate models for individual models. Here's the ride-hailing model. Some OPEX modeling. And there are a couple of other modules. Ultimately, all this work serves to improving forecast accuracy. And forecast accuracy is not about getting EPS right to plus minus 1%, but it's about capturing investor sentiment about future products. And in order to make accurate share price predictions, you need to know when the sentiment could hit investors long before they show up in the P&L. And that's why EPS forecasting is completely inadequate, as this quarterly call proved yet again, because again, the EPS didn't move the stock, but what was said on the call moved the stock. With that, thanks for watching. See you in the next one. Bye.